watching Rogers TV.
Hello, everyone, and welcome to Money Matters with Shannon Jackson, the personal finance show focused on moving you forward financially. On today's show, we're focusing on advice for mortgage holders amid higher interest rates. Those carrying a variable rate mortgage have already been feeling the impact of the recent rate hikes, and those carrying fixed term mortgages are perhaps dreading renewal time that might be coming up. And if you've been following the news, you've likely seen the stories about homeowners who are worried about possibly losing their homes or even maybe selling their homes. And if you're among them, today's show is really for you. Joining me to talk about it today, we have Cory Kline, mortgage agent at Neighbourhood Dominion Lending Centres. Cory, thanks for being here today.
Hey, Shannon, thanks for having me on the show again. I really appreciate the opportunity here.
Before we get into our discussion, can you tell us a little bit about your background and what you do specifically in your business?
Yeah, so I'm a mortgage agent here in Barrie, Ontario. I've been doing mortgages for 25 years, since 1998, but specifically with me, I try to focus on helping existing homeowners with their budget, trying to find ways to increase their cash flow and just make life more fun and more secure at the same time.
And are you seeing, because of these rate hikes, have you been seeing sort of an increase in business with people coming to see you?
There's been an adjustment of the type of people that are coming in. So where before it was more of a mix of first-time buyers and people, or even people moving up or down, a lot of people seem to be staying put. So it's just we're still seeing people. It's just for different reasons now, and perhaps they made a challenging decision before, and now they have another challenging decision to make now.
So it sounds like maybe the clientele or the type of clientele has maybe changed over the last couple of years. So that's making sense with what's been happening with the economy. So as we get into our discussion, of course, we're talking about the rising interest rates and the impact that these are having on homeowners. Before we sort of really dig into that, what are you hearing from the clients that you see, especially homeowners here in Simcoe County?
It's a real mix. So there are definitely families who are in some undesirable situations, and they're being forced to make some tough decisions. And thankfully, I'm finding a lot of them are reaching out with their questions, because a lot of times in lending, everything is backwards to what you would think is common sense. So it's always great to reach out. But shockingly, the majority of clients that are reaching out and calling me, they have this level of confidence that everything's going to work out fine for them. But keep in mind, at the same time, those are the ones that are reaching out and having the conversations early, as opposed to waiting until maybe it's too late for them.
Well, we know that people are feeling the strain of the interest rates, especially on homeowners, and because it's been making the news now for many months, and it's really sort of no wonder that people are feeling this. We've seen one of the sharpest and quickest interest rate hikes in recent history. There have been 10 increases to interest rates since March of 2022. And the key lending rate went from literally rock bottom of 0.25%, which is really close to zero, where it now sits at 5%. And as we know, when rates increase, so does the cost of servicing that debt. So those who have been carrying variable rate debt, they were impacted immediately and have been feeling it for the last couple of years. And this is also including lines of credit or home equity lines of credit with the variable rate mortgages. And so the difference in those monthly payments, I think, has been substantial for a lot of people. So I want to get into that, Cory, a little bit. Can you share some examples of how much more some homeowners are paying just as a result of their variable rate mortgages?
Absolutely. And before I do that, just for the viewers, I just want to recap the difference between a variable rate mortgage and an adjustable rate mortgage, because there's a striking difference between them. So with a variable rate mortgage, the rate changes, but the payment doesn't necessarily change. It's just the mix of how much is going to principal and interest will change. Or with an adjustable rate mortgage, or an ARM, every time that the rate changes, the client's payment changes as well. So, and that's what we're alluding to right now, is these adjustments people have been feeling on on the regular every time rates have gone up. So if we want to use an example of someone with maybe a $500,000 mortgage, if they started and the rate on the variable might have, or sorry, on the adjustable might have been around 2%, then their payment might have been around $2,000 a month. And then, every quarter% increase, their payment would shift maybe $60, $60. But with all the increases, that $2,000 payment, now that rates have gone from around 2% to nearing 7% for maybe that same client, we're looking at a payment of about $3,300. So that's about a $1,300 increase for that family, and that's a lot of money. It's hard to come up with the extra dough. And if you have a $1.5 million mortgage, that payment is more like a $4,000 increase. It would have started around $6,000, and it'd probably be nearing $10,000 a month now.
That's a huge impact on people, especially. I mean, obviously, the higher your mortgage is, the higher your payment is going to be, no matter what. But those changes in rates have absolutely had a drastic impact, I think, on some of these mortgages that people are carrying. And I thank you for clarifying that difference between, you said there was an adjustable rate mortgage, and then the other one was?
The variable rate mortgage.
The variable rate mortgage. And so one of those options was, as soon as the rate changes, your payment will change immediately, and that's the variable rate?
It's the adjustable rate. So your payment adjusts as your rate adjusts.
Okay. Otherwise, if it's the variable rate, then your payment will stay the same, but the amount going to the principal and the interest portion changes with the rate changes, correct?
Correct. And in both cases, with the increases that we've seen, they both have negative implications for the borrower. They're just different. Some of the borrowers are feeling that payment every time things shift. And I believe that's the right way, so that people are in tune with what's going on with their mortgage. The other way is their payment's staying low. So their payment is if the rate is 2%. But if the rate is getting close to 7%, their payment isn't even covering the mortgage or the interest anymore. So these families are making their full payment as agreed, but the payment or their mortgage balance can actually be going up each single month.
Thank you, because that helps clarify for me as well, the difference between the two of them. So that's really good information. I appreciate that. So maybe now shifting to sort of the fixed term mortgage holders, they have maybe sort of been a little bit relieved over the last few years because they haven't had to experience these rate hikes sort of on a more immediate basis. But we know that millions of these mortgages are going to be coming to term in the next year, couple of years. And I think there's going to be some sticker shock for homeowners. I personally was one of them this year. I had to renew my mortgage, and it was a significant change. And there was a recent report released from Royal LePage that suggests over 3 million Canadians are facing mortgage renewals in the next 18 months. And the majority of them, unfortunately, are worried. There was a survey as well from Manulife Bank of Canada that said nearly 1 in 4 homeowners are worried they will have to sell their home. That's 25% of people are worried about having to sell their home. And about 18% of homeowners think, or they're admitting that they're already at the stage that they can't afford their homes. There was the latest Equifax Canada data. We're seeing trends where mortgage holders are now missing payments, and including people here in Ontario. So this is certainly a red flag, because we know in the last couple of months, we saw there was a release from the International Monetary Fund warning that Canada runs the highest risk of mortgage defaults among advanced economies. So, Cory, when you hear these statistics, is it shocking? Is it surprising? Is it concerning? What are your thoughts?
All of the above and other as well. So we are seeing mortgage delinquencies start to creep up a bit, but in speaking to our lenders, what we're seeing is it's the up to 30 days and up to 60-day ranges. So not that people are getting beyond being 2 months late. They're a month late, or they're weeks late, but we're not getting to the point where it's became a major issue yet. So somehow Canadians have been able to figure it out, make changes. I know people are getting second jobs. I think a lot of people, though, are taking action. And I think the key is to control what you can control. Like you can't control if interest rates are going to go up or not. But you can take a look at your own personal situation, and perhaps there's other, like perhaps it's a refinance or to lower the other costs, your debt costs, your automotive costs, things like that. And then you're able to balance it out. So I think, we have a very strong lending model in Canada, especially on the real estate mortgage side, and so there's options there if somebody's willing to look into them.
And so, like I personally have seen this trending upwards in my practice as well, where I'm seeing more and more people coming in to see me with their unmanageable debt load, and it used to be where they were handling their unsecured debt just fine. Or I'm sorry, their unsecured debt was unmanageable, but their secured debt, like their mortgages and things like that, they were managing that. But I'm seeing now an increase in people where they're not able to manage both of those. And like you say as well, I'm seeing exactly the same where they're not 6 months behind in their mortgage payments. They're 1 or 2 months behind, and they have reached out to their mortgage holder to negotiate, maybe work out some kind of strategy to get those arrears caught up. And I think banks are open to that conversation. We'll cover this a little bit in our second segment, but there are some strategies I think that the banks have come up with to help homeowners, especially, I think, because personally I'm concerned about coming back to the 2008-2009 real estate crisis, really, that we experienced, and I'm worried that might be coming again. Do you have any thoughts as to, do you think it's going to get as bad as the 2008 problem?
I think the saving grace is going to be from about 2018 on is the stress test coming into play. And we really put in a buffer to help us, knowing that rates at some point would go up, that we're qualifying people for those adjustments. Now, people still need to adjust their lifestyle. But when you look back, these people that got a 1%, 2%, 3% mortgage, they were being qualified at 4%, 5%, 6%. So it's not that it's impossible perhaps for them to do it, but there are going to be changes that might need to be made.
Well, Cory, this has been really good information. And we know that the federal government is encouraging banks to work with consumers, especially mortgage holders, as I mentioned before. And banks have implemented some strategies, but the question is, are these strategies going to be real solutions as we move forward? And what are some things homeowners can be doing now to protect themselves financially? We're going to get into all of that, and Cory's going to have some great advice for you coming up when Money Matters returns.
This program is brought to you by Ignite TV. Now you're in command. Visit Rogers.com for more details.
Public transit, garbage pickup, parks and recreation programs, snow removal on your street. How can you stay informed about these and other important local services? Tune to City Council coverage on Rogers TV. See your community leaders at work on Rogers TV City Council coverage.
Welcome back to Money Matters with Shannon Jackson. My guest today is Cory Kline, mortgage agent at Neighbourhood Dominion Lending Centres. And today we're focusing on advice for mortgage holders amid higher interest rates. Now, as we know, the rate increases over the past year and a half have left many homeowners worried. They're worried about being able to afford their mortgage, perhaps worried about being able to stay in their home, and some are worried about passing the mortgage stress test at renewal time. And Cory, you touched on this a little bit in the first segment. Can you talk a little bit about this stress test? What is involved in that?
So the stress test itself is fairly simple. It's getting somebody approved at a hypothetical rate that's higher than their actual rate. So today, let's say someone's getting approved for to purchase their first home and it's 4.99%. We actually get them approved as if the rate was 2% higher at 6.99%. So that payment's going to be hundreds of dollars higher, just to build in a buffer, just to say, okay, not only do we know you can approve or you can afford the house today, but down the road, if rates are higher, or maybe even if you've taken on a little bit of debt, that this should still be affordable, that we're not taking people right up to the maximum threshold.
Are you seeing an increase in people not being able to meet this stress test right now?
People, there was an adjustment immediately when the stress test came out. So there, because unfortunately, as a society, we seem to want to buy everything as high as we possibly can. We want the biggest houses and biggest cars and best travel and so forth. So when I think the stress test was kind of put in to help us limit ourselves. So there's definitely adjustment. And sometimes it is there to protect well, it really is there to protect the client, because we don't want to put them into a situation where they can't afford to weather any type of storm, that everything has to be absolutely perfect in order for them to be able to make their payments. And same thing on the banking front. The banks don't want to have people that are in a house that can't afford the payment. The bank never wants to be in the position where they're taking back a house and putting it on the market to sell. They want to be a partner in this with you, and they want to be successful. So this was just I think, and I was always behind this when the government brought it out. I thought it was a great idea. I mean, we complain about it, and even I complain about it, and my clients definitely complain about it because it's limiting their buying power, but perhaps that's in everyone's best interest.
And so I agree with you. I like that this stress test has been put in place because, like you say, it's a protection for us as consumers, but it's also protection for the banks as well as we move forward in the economy. For those who might be worried about managing a higher mortgage payment, do you have any advice for them how they can maybe lower the payment or make it just a little bit easier on their cash flow?
Yeah, absolutely. And first, before answering that, because I know a lot of people are stressed about the stress test and their mortgage renewal. Like, we have a lot of people that got into their first home, sometimes with a parent co-signing or on their own in the last few years, and they've never experienced a renewal before. And they're hearing about the stress test and they're concerned, oh my goodness, am I going to be kicked out of my house? What's going to happen? So generally speaking, when we're dealing with AAA lenders, the First Nationals, MCAPs, Manulife, the Canadian banks, when you get that approval, it's a 25 or 30-year approval usually. So what happens is you generally will just get a letter in the mail saying, what would you like to do next? Tick the box, sign it, and return it. And you go for another 1 year, 5 years, or whatever you're choosing. So I've never, I understand from the media what's been said that perhaps there's a extra level of anxiety with regards to renewals. But I'd say that shouldn't really be there just for renewing a general AAA mortgage. Now, if you were coming up for renewal and you were at 2% and you're looking at 4 or 5% rates now, you do have to think about, how am I going to adjust for that payment? And the biggest thing that I'm seeing is, because there has been a large increase in values, even though they've softened a little bit, the homes are generally much higher than when somebody bought them. And if part of the solution is refinancing, maybe eliminating a car payment or some debt payments, maybe even taking it up to a 30-year amortization, so that these things together can buffer the difference or offset the difference between the rate going from 2 to 6%. In a lot of cases, clients find that even though their rate is going up, if they do this planning, their actual payments going down, their cash flow is going up. And a lot of times we're able to get them some cash so that they are able to weather any storms that come at them in the future.
I like that. I think you've just said some things that have given some people some optimism and some hope moving forward. So that's really, really helpful. Moving towards the people that might have never owned a home before, like you say, these first-time home buyers, and they're worried about having to enter the market as it currently stands. Do you have any advice for those particular individuals?
Personally, my advice is to lower your expectations. When you're buying your first house, it doesn't have to have the shiny counters, and it doesn't need to be a 4-bedroom. Especially if it's just the two of you. I know ideally that would be the case, but just getting into the market, I start there. If it's a small condo, if it's a older townhouse, just make sure it's a house with good bones that you're not going to be spending a fortune on repairing. But I think the most underutilized mortgage product out there is purchase plus improvements, where someone can go out and they can buy a house that they can afford. Maybe it's at a lower price point because it's outdated, there's wallpaper from the 70s or so forth. But you can go in and you partner with the bank and you say, okay, look, I want to buy this house and I'm going to redo the floors. And maybe I'm going to put in new counters and maybe new cupboards or bathrooms or whatever it is that is going to make this house yours, what you really wanted in the house. So maybe you're able to buy that house for maybe $100,000 or $200,000 less than your dream home. Maybe you could add in $40,000 of renovation costs to the mortgage and still end up with a house that you want and a payment you can afford. And I really think that product is underutilized, and I hope more people start using it in the future.
That's really good information, because I wasn't aware of that particular sort of advantage product. And I agree with you about sort of lowering those expectations, because you can put a lot of love and work into a sort of I don't want to say a fixer-upper, because that sounds like it's going to be a lot of expense moving into it, but something that just needs a little bit of cosmetic improvements, and you can do that yourself over the next 5 or 10 years. I think it can make a huge difference. So I agree with your opinion on that. And now for those who are facing a renewal and they've received the letter from the bank that the renewal is coming up, do you have any advice about reaching out to a mortgage broker like yourself at renewal time?
Yeah, you want to have these conversations as soon as possible. Personally, I wouldn't even wait for the letter to come out. Like, if you know you've got a mortgage coming up for renewal in the next, any time frame that worries you, but particularly in the next year, it's time to get the conversation started. There are changes that happen in the mortgage industry regularly. Like, for example, I had a client approved for an option to refinance their house in October. And then they weren't sure if they wanted to do it. And they just said they wanted to wait a little while. And then they came back right after the holidays and they said, hey, Cory, we want to go ahead with that plan. And so I went back to the bank to get it again. They said, well, sorry, we don't offer that in that way anymore. So now the clients are looking at different solutions. The other thing is, with real estate values changing, that the higher the house value is, the more options you might have with lenders. So it's always, I think, good just to reach out, get the ball rolling. And if you find a solution that works for you, I would take action and jump on it while it's there and available.
Is there a benefit to switching lenders for your mortgage?
I don't think there's a benefit in not switching. When clients come to me, when we sit down, we take a look at what I can do for them. And I tell them to talk to their bank as well and just compare the two options, and whatever they feel more comfortable with is the way to go. But if they don't investigate looking at different options, like the thing you really don't want to do is just sign that renewal letter. For two reasons. One, those rates are extremely high. Normally, what you get in the mail is they're hoping that you're scared and that you'll just sign, and that they get to charge you much higher interest rates and make more profit. So that's the one reason. But I think more importantly is, before you sign up for 5 more years of the plan that you're on, is to take a look at, should you change your plan? Should I take a look at refinancing? Should I take a look at reamortization before you lock into 5 years? And just having a second opinion, a second set of eyes on that, but from a professional, I can't see how it can hurt.
Yeah, absolutely. Now, we mentioned a little bit earlier that the government is encouraging banks to work with consumers, especially those who are holding mortgages. And they've implemented some strategies to ensure that mortgage payments are being made. A few of them are that mortgage holders are either being asked to pay more money on a monthly basis, or perhaps they're extending their amortization period from an average of perhaps 25 years to upwards of 40 years, which is astronomical. Or they might participate in negative amortization, which is when the monthly interest that is not being paid is then just tacked back onto the principal. So, Cory, these strategies, are these really long-term solutions or just sort of a Band-Aid?
I think Band-Aid, and I think, when we look at what's the actual problem, I think a lot of times it's that income and the lifestyle difference. So it's not going to address that. So a Band-Aid solution is, but if you're in that situation where you're struggling, you're worried about losing your house, you don't care about amortization, you don't care about interest rate, you care about keeping your family safe in that home until you can figure it out. So it doesn't mean just take the solution from the bank and just wait. You take that solution and then you look at other options, you look at what you can do to make the changes so that you can have the happy lifestyle that you're looking for. So it's part of the solution, let's say.
Yeah, when I hear some of these options, especially about either increasing the amortization period over much longer years or this negative amortization, that seems to me you're just going to end up paying interest on interest in that strategy. So I feel like these are sort of short-term issues, but or short-term solutions perhaps, but you're right about sort of reevaluating your cash flow and your living expenses and things like that, and find other ways to perhaps make the mortgage a little bit more manageable for you. Now, speaking about that, some homeowners and banks are keeping an eye on something called a trigger rate. Can you explain what exactly this is?
Yeah, absolutely. So the trigger rate is more on the variable rate side mortgages where your payment's staying the same, but the interest rate's going up. So in the small print of a variable rate mortgage, standard mortgage terms, you're going to see, at what level the bank is going to want to take some action if things get out of hand. And things have been getting out of hand, taking people from 1-2% rates into 5-6-7% interest rate ranges. And so, at that point, the banks are calling up the client and they're saying, okay, how are we going to deal with this? How are we going to make sure things go well? Do you have money you can make an extra payment to the mortgage? Usually not. So then the next plan is, okay, how much can we increase this payment to try to keep you on track so that you are at least heading in the right direction? So the banks have been very proactive in reaching out and trying to make that happen, but it's there's some very tough choices for people to make, and sometimes it needs a reevaluation of just your priorities and what you really want to see happen, because when tough choices are to be made, you want to be thinking clearly.
Well, Cory, all of the information that you've given us today has been really useful, and I really appreciate you being here. For those of our viewers who want to connect with you, maybe follow you on social media, how can they do that?
If you go onto Google, Facebook, Instagram, you just put in Cory Kline Mortgage, you'll find me pretty easy.
Well, thank you again so much for being here. I think you've given a lot of hope to our viewers as we move into the next couple of years and facing our mortgage renewals and things like that. So thank you again for being here on Money Matters and sharing all of your great advice. And I also want to thank you, our viewers, for watching. Until next time, I'm Shannon Jackson.
Connect with us by visiting our website or email us at comments@rogerstv.com.
Today, I helped a senior find transportation to an important medical